What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is September 19th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, and welcome yet again to another Macro Monday special here on the DataDash channel. It's a jam-packed episode today. We're going to be talking about our updated price levels for Bitcoin, and on top of that, the two major macro dynamics that are giving us full confidence that inflation is here to stay and that we have much more pain to come before things are going to get better. We're only trying to look at the rational outlook here, guys. If you happen to like this video, consider dropping a like, and let's go ahead and kick things off. Now, I want to start here by taking a look at our updated technical analysis on CoinPanel, one of our partner tools here on the channel, where you guys can track my TA live in real time when I make these updates. Now, I want to go ahead and make one thing clear off the bat. You all probably recognize, if you're avid viewers here of the Macro Monday special, that we usually are looking at the 4-hour time frame. But folks, we have taken it from the 4-hour time frame to the weekly time frame. I hope it makes it clear that we're talking about much more downside to come here before we see greener pastures. Now, the macro segments we'll talk about a little bit later will provide some background to this. But first, let's just go ahead and talk about the few dynamics here that we have at play. First off, taking a look here at our dialogue, we have three key bullet points here. We still remain short-term bearish here for our update on September 19th. Yet again, we hit our target of 18,800 as we wrote about since back in August, and now we're on our way to testing the next major level of previous resistance at $14,000. I know it sounds too good to be true, it sounds too far out, or it might sound too doomish overall, or doom and gloom for that matter. But we'll talk about why that's a pretty rational level here considering previous price action in the past. We've also seen something that is absolutely damning for Bitcoin's price, to be just completely frank with you guys. We've seen both the 200-week EMA and the standard moving average acting as clear resistance rather than support. Now, it has been historically proven that when Bitcoin goes below these moving averages, usually it's a time to buy. It's a time to get optimistic. It's a sign of capitulation, a time to go long. But what we saw throughout this summer was not only just a relief rally in price, as we wrote about and talked about back throughout the months of July and August, and took advantage of. In that case, we started to sell our positions throughout that. But on top of that, we emphasized that if we cannot clear through those levels and that we start treating it as resistance, we are entering into nothing other than uncharted territory here for Bitcoin. Simply put, we have not seen these circumstances ever play out for Bitcoin. Usually price breaks below the weekly moving averages and rallies out of it due to people buying in to the capitulation, likely signaling the end of a decade-long secular bull market that Bitcoin has lived through alongside the broader range of equities in the stock market. And this speaks to a bigger overall statement here that I'm making, which is that I think we're seeing something we've never seen for Bitcoin before. I think we are seeing the end of the decade-long bull run where Bitcoin was the leading asset comparative to other asset classes like stocks, gold, other commodities, and properties. Simply put, we need to get prepared for the worst. And at a minimum, expect that Bitcoin is going to do what it's done through previous bear markets. So where do we pull our price levels from? Well, the levels I'm pulling here are not just being pulled out of a hat. They come with pretty decent rationale. Not only with the fact that we've treated these moving averages as resistance and are rolling back over down to the lows here, likely proving that this isn't the capitulation or consolidation channel that many people were expecting it would be, but the next key level here would be around 14,000. Not only is it a big even level here, but you've got two dynamics at play. We've got clear multiple retests at this range as potential resistance in the past, with it being broken here back in October of 2020. But on top of that, this is a clean-cut, near 80% correction for Bitcoin's price at this level, which is very similar to previous bear markets in the past. I think this is the bare minimum we can ask for at this point, considering the resistance at that 200-week. And on top of that, we need to be considerate of the idea that we might even get a further worst-case scenario. I know this sounds too far out, guys, but we have to consider the idea that we might get a more harsher bear market correction here, similar to some of the older bear markets of around 85%, taking us down to the big 5-digit even level of $10,000. All right, I don't want to say this is guaranteed or set in stone. As you all can see from the text dialog we talked about at the top, we right now are just estimating that we're going to come down to 14K. And in this basketed range here, right, this is where I'm going to start getting a little bit more optimistic on Bitcoin. I'm going to start putting away all my fearful emotions aside here. I'm not saying per se that I'm emotional about it, but what I mean here is I'm going to start getting a lot more optimistic and greedy in the market. I'm going to start, when everyone's starting to capitulate and going, oh my God, this is going to start going to 3K or whatever, that's where I might start getting a little bit more greedy and start getting some exposure in the market, right? So again, just keep that in mind here. And this is again why we took advantage of the relief rally here in the market. Now, hopping over here to Ethereum in order to keep conservative on our time, we've got some other key price levels to talk about. Boy, do we have some updates here on Ethereum. Let's go ahead, take a look at the dialog here for our updated TA. Yet again, like Bitcoin, viewing things on the weekly time frame, we have hit our target, or at least close to it. We haven't hit it exactly yet, but we're just about to hit the 1250 level that we wrote about, that we should have hit by the end of September, like we talked about in our August analysis, and we have yet again hit that target range like we did with Bitcoin. And we're likely on our way to retesting lows here in October. The merge, as we discussed, had zero positive effect on price post-launch. This was a clear buy the hype, sell the news event. And I'm not meaning here to bash on anyone. I know a lot of you guys might have held ETH into the merge on that bet. And look, guys, everyone's got to go through these learning lessons. I've been through it before, trading Bitcoin updates in the past, all types of different network upgrades, and also holding stocks and the equity markets into these really exciting supposed releases of products or news. And it turns out that it's already been priced in. And that's exactly why Ethereum went, as we talked about, from $800 to $2,000 here over the past couple of months in the summer. But now we have to solely rely that buyers are going to find a price point where they feel that Ethereum is fundamentally undervalued, essentially when there are more buyers than sellers. And that is a very, very unreliable indicator, or I guess kind of catalyst to hope on. There isn't anything that's going to be driving Ethereum dramatically higher unless there's some black swan or anything that could come up. And we always keep open to that, right? We don't want to speak in absolutes, but to be honest with you all, if I'm putting my money on it, with my positions at the moment, we are mainly in cash and looking for Ethereum at a minimum to be retesting $800 to $1,000 due to the growing levels of capitulation in the market, the rapid rates of sell-off, and with no serious signs of support here on the moving averages here for the weekly time frame, right? We are clearly seeing that we had a deviation above the 200 EMA, and because of that, we are likely going to be continuing lower to other price levels. Now, it is important to understand, guys, that in a traditional bear market, or at least the previous bear market we had, Ethereum did much worse than many people are expecting is going to happen this time around. We had an over 90% correction, double-digit capitulation from 1,400 down towards $80. Went from 4 digits to 2 digits here. A lot of people said it couldn't happen. We had 2 retests of that range before we really kicked off the next bull market. And this is why I talk about not rushing in to a bear market, because we not only expect at a minimum, a double retest here at the 80% decline range at $1,000 big even level. But on top of that, we've got some other ranges here we need to watch, like $750. Now, this would take us down to around an 85% decline in Ethereum's price. But there are also other target ranges here, like $500, another big even level, 50% lower than the range we're at a minimum calling for here by October or sometime here in the fall, which is a 90% decline. And then, of course, the doomsday scenario here at around 300. I can tell you all, don't be surprised if this happens, because we're likely not only seeing a bear market, but on top of that, we could be seeing an end to the secular bull market that we've been in crypto and digital assets for the past decade. And that could be disastrous, not just for Bitcoin, but Ethereum and other altcoins. So we're going to continue to keep an eye on this here. Again, watching these levels. I'm not saying these are set in stone. I want to emphasize that, but they're levels we need to watch here. Now, taking a look at Bookmap here to get further confirmation of this, we had, although some positive market order flow and move on the cumulative volume delta. This is tracking the market buy side pressure or sell side pressure. While we did get some excitement here around 2000, we faced heavy resistance and a lackluster amount of buy side support to continue that trend. It practically flatlined after this wave of buyers came in. And after multiple days here throughout September of decline, we saw market order flow quickly resume back to neutral territory and go back into the red. So we're not only facing heavy resistance here, according to Bookmap, on the order book, the asks on the order book that are weighing down price and absorbing any market order flow here. But on top of that, we aren't seeing the kind of market order flow we would want to see during a a consolidation phase here, essentially. We'd want to see much more market buy-side pressure coming in. And unfortunately, we're not getting that, and we're still getting heavy resistance on the order book for the most part. So that is a key thing here. I highly recommend, if you guys haven't already, definitely check out Bookmap. It's a really exciting tool where you guys can use this not only on shorter term time frames with tools like their liquidation tracker, things that can really give you an up edge on the market when it comes to short-term trading, but also when getting these longer-term time frames. They're starting to get much better at pulling longer-term data. And with multi-book here, we can see the bid and ask support as well as the general market order flow across the exchanges really gives us a lot more oversight than just looking at one single exchange. Now, let's go ahead and dive into the macro conversation here. If you guys have stuck around, this is where the really interesting conversation starts to kick in and why those price points we're talking about start to make a whole lot more sense, right? We need to step out of crypto. We need to start talking about what's going on in the cost of energy commodities, as well as what's going on in the housing market. Now, one thing that the bulls have when it comes to crypto and stocks is the prices for commodities, or at least that's the narrative. Everyone's very excited about energy commodities starting to decline here. They're at some of their lowest levels that we've been at in over the entire year, practically back since January, right? We've been chartering around here, looking like we're at a minimum coming down to retest those lows near around $80 a barrel for oil. Again, the lowest price points as far back as January this year. Now, this is great progress here. This is good to see that we're starting to see commodities come back down to more rational and reasonable levels here, and not up to those highs we saw back in February and March for oil here. Now, this is, of course, what we need to see in order to cool down inflation, and is a sign that we're entering into the later stages of inflationary pressure, i.e. essentially going through stagflation, where still prices remain relatively elevated. We're trying to wait for salaries to start to catch up, but inevitably we are entering into a recession. Whether the Federal Reserve states it or not, this is their key goal. They need to, not only on a geopolitical factor, in order to fight against Russia's revenue stream here, if the whole war, the geopolitical war going on, they need to crater demand here in order to bring down commodity prices. But also, of course, for consumers at home, they need to put in a recession in order to bring down commodity-based inflation and to allow for supply to take advantage and catch up here in order to yet again weigh down prices even further. Now, it's not just oil here. I got to be honest with you all. Some of you have pointed out rightfully that natural gas has started to decline here. We've gone from around $10 to 7.5 here on the contracts for difference for natural gas. Yet again, coming down into what may be a capitulative retest here down towards around 6.4. Now, this overall, again, while it is a sign of a recession and could very well mean further decline of assets, is definitely exciting to see. Right? It's exciting to see that we're starting to see some of the things that are, again, driving inflation starting to, at a minimum, keep neutral or potentially start to cool down and start a trend of lower highs and lower lows. But I want to make it very clear here to not get too excited too soon. While we do have equities at a nice discount here, and we are starting to see as well in the more specific chart for Dutch natural gas here. This is again another way to really track the ridiculousness of energy prices in Europe and how crippling this has been throughout 2021 going into 2022. We need to understand here that while the chart looks like it's had its parabolic blow off top, it looks like it's exhausted, it can't go any higher, then on the logarithmic chart, it shows us we can't get too confident too soon. And there are a lot of things that can start to keep this price elevated as we step into the winter months. That's the important thing we got to keep in mind, guys. This trend has already been going up north here throughout 2021 before the war really broke out. Right, the markets were starting to price this in extensively, and we have only kept elevated around this range where we used to keep at the highs as a new range of support here, potentially, over the next coming weeks. It is important to stay vigilant, to not get too optimistic, and on top of that, we'll talk a little bit later on about how the market is already telling us here that these energy prices, even though they've gone through a slight decline here over the past few weeks, may not be enough of a telltale sign, and that there may be something else out there that is spooking markets, right? But keeping on this topic of energy, here are some of the positives and the negatives. First off, we've started to see tanker companies that are working on shipping oil and natural gas, or LNG carriers for short. They've started to alleviate some of that stress on Europe for their energy markets. But this has, of course, led shipping rates to skyrocket to over $100,000 per day. Oil tanker rates are continuing to remain elevated here due to the demand for liquid natural gas and crude oil and other refined products to get shipped over. But this is still generally a positive piece of news here for energy markets that could alleviate some of the pain going into the winter, especially if this continues to expand. And on top of that, it is important to understand that flows are continuing to go through Ukraine even though Nord Stream 1 remains shut. So we are starting to see here that, again, Russia doesn't want to essentially cut itself dry. It's just essentially cutting off some of its income stream in order to apply that pressure. This is something that Russia has done in the past. They have done this before in order to put pain on Europe when these geopolitical tensions pick up. This happened back almost nearly a decade ago between Russia, Ukraine, and Europe. So it's important to understand history here. We still have some gas flows running through here to Europe, but Nord Stream 1 remains shut. So this is important to understand here. One of the major German pipelines is shut down at the moment. Now, the important thing here to understand is that there is some things to be worried about here going into the winter. There is likely going to be, and I say this as someone who lives in Europe. Most of the time I'm traveling in the US at the moment to visit family, but there is likely going to be a very, very brutal winter, as we talked about in our last video. It's not even being melodramatic here. Winter is coming. It is going to be a difficult year here because energy is such a staple here that we take for granted, as we likely are preparing for blackouts ahead in the coming months. Not to mention, a lot of factories are starting to plan to go in the dark, and this is likely going to exacerbate, as we go into the holiday season, consumer-based inflation. It is important to understand that this is only going to disrupt the supply chain. Something that people really don't, I guess we kind of take for granted or don't understand sometimes. It's taken me years to really understand this, is just how important abundant energy is, right? In order to have a fluid supply chain, in order to be able to have low energy costs, right? In order to have an abundant supply chain, we need to maintain lower energy costs. And unfortunately, not only are we seeing a lot of talks about blackouts, we are seeing environmental groups yet again attacking the EU, that they are now labeling natural gas, which does have a lower greenhouse gas effect than oil or coal, which now a lot of EU plants are starting to have to come back online, a lot of their coal-fired power plants, because of the step they took against nuclear. And now that they're starting to re-embrace nuclear, ironically enough, people yet again are starting to attack it. One of the few zero-emission technologies out there that, again, is only being cratered down by the fears of nuclear waste, which has been relevant for hundreds of years and has not caused any significant issues whatsoever. Sorry I'm a little bit opinionated on it, guys, but I've been on the nuclear debate. I used to be on the complete opposite other side of the argument, and as time progressed, I came to the conclusion that this is just silly. To think that we can live without nuclear here going into this energy crisis is absolutely a fool's gambit. There's no way you can shut down these nuclear reactors, and the EU, of course, is facing the consequences here. Not per se the EU, but the people of the European Union are facing the consequences of this failed policy that has just been crippling the EU over the last few years. So we're going to be dealing with all kinds of stuff like this as Europe starts to switch back on coal-fired power plants, natural gas, nuclear power plants. And this is going to just cause more tailwinds here if they face any of these dire consequences. Now, I don't think they're going to do this, but again, this can again spook markets when it comes to legal action. So, as we come here towards a close here and talking about the natural gas and oil prices in the market, what do we have to be worried about? What else out there is really causing concern for me, right? If energy markets are teetering on being relatively neutral and maybe even cooling down here, what is it out there that's potentially spooking the markets? Well, It's not just me, again, just saying this, guys. I want to go ahead and bring up an important chart here. This is the U.S. 30-year yield, the U.S. 30-year Treasury yield. Now, we've seen over the past 2 days here, we've seen the yield push up yet again to new relative highs, the highest level we have seen going all the way back here since 2014. And to signal even further concern here, right? Bond yields are moving up here as the appetite for bonds is starting to go up, right? The highest level we've seen since 2007. Now, why are bond yields going up so high here? The reason? Concerns around the cost of living and the housing market. Now, when we talked about the Fed needing to cause a recession, we need to understand here that this could very well be depressionary levels of recession. And there's a reason why this is likely the case. And the bond market, with its biggest weekly jump here since back in August, and its biggest jump since back here in June, there is a reason the 2-year yield is not only paying a higher yield, right, than the 30-year yield, which is already a worrying sign here, an inversion yield curve, right? The change between the 2 and the 20-year yield. It's already been inverted, a sign, a historic sign, one of the clearest of an upcoming recession. But there's a big reason why it's continuing to climb higher, and it has to do with the dynamics of the cost of living. Now, I know a lot of people are saying, well, Nick, hold on a sec. Energy prices are starting to go down. Oil and natural gas, we just talked about it, are starting to go down. How could the cost of living be rising higher? Food prices, yeah, they're elevated, but they're maybe not going up so extreme. The big reason is that we've got one last domino to take down. The Fed has one last category it needs to take down that makes up a much bigger part of the CPI, and that is the cost of shelter. Shelter makes up a huge portion, nearly 1/3 of the entire cost of the CPI. Now, we need to talk about the cost of the rental market. This is really big here. Over the last decade, the housing market has been plagued by a very big issue. Now, I do not mean to insult anyone. I do not mean to call anyone out. There are plenty of probably people out there who watch this channel who might have participated in this, and there are also a lot of content creators and people out there who encourage this kind of behavior. And that is simply the game of purchasing property, which has historically been a good way to preserve capital, to hedge wealth, right? Buying a second, third, fourth, fifth property, and taking those properties out onto the market, turning them into rental properties, turning them into Airbnbs, making them essentially productive assets. This has squeezed dry the supply of homes in the market and led to the hyperinflated prices we've seen, not to mention due to the fact that we've printed tons of enormous amounts of money into the market. This created a huge lack of supply in the market, exacerbating prices to new highs, and what many people thought was likely going to be the new normal. Now, the cost of living has already increased rapidly, but it's about to get worse before it gets better. And here's the reason why. On this chart here, we're taking a look at the mortgage rate, the 30-year fixed mortgage rate average in the United States, according to Freddie Mac. Now, you all know that mortgage rates have been on a huge decline over the past few decades. We've talked about this before on the channel, where it got down to basically where it was around 2-something%, roughly speaking, for a mortgage. Man, if you got that at the fixed rate mortgage, you're a lucky guy. And on top of that, even if you bought your property recently, probably going to be in good hands, because that's great levels of financing. 2% is wonderful. But going from 2.5% up here to 6%, we have just broken to a new high here in the month of September, a new high in mortgages, the highest rate we have seen since 2008. Now, just to kind of put this into context here, what this essentially means is that all those people who have taken out financing, who didn't get fixed rate mortgages, right? Now, this is one dynamic here. We're talking about fixed rate mortgages. If you had gotten a variable rate mortgage, the rate is coming up into this range now. And whatever your mortgage payment is, right, whatever you're paying, each and every month, not only your base principal, but the interest owed on top of it is going to get a heck of a lot more expensive. Now, here's the sad reality. You would likely expect that the landlords in this case would stomach the cost themselves. They're the ones speculating on the property, right? Well, that's likely not the case. In order to keep from going underwater here, the landlords are going to do what they're going to do for survival, and that means they're going to jack up rents. If they owe the bank more, in order to avoid insolvency and defaults and have to be essentially delinquent on their payments, they are going to jack up rents. This is one of the big reasons why rents have been spiking since the pandemic. Since we've been seeing here essentially that the Federal Reserve has had to start to raise interest rates, that is going to, at a minimum, raise the rate for mortgages as well. And that is going to put inflationary pressure on not only the cost of properties here, the money people are spending. Even if property values go down, people are going to be spending more in order to buy properties. But on top of that, it is going to jack up the base cost that everyone has to pay if they don't own a property, and that is rent. Further crippling people who are already hurt enough here in the economy. It's so sad. It's not something I'm like shouting that I'm happy about. Trust me, guys, I'm at a point in my life where I'm looking to buy a property, and I'm currently a renter at the moment. And man, I don't even want to think about the kind of pain that some other people might be going through at the moment. It's difficult. It's difficult to get financing that makes sense at this point. And this is going to lead towards a massive surplus of housing in the market. It is going to lead to a flash sale in valuations eventually. And that's exactly, unfortunately, what the Federal Reserve needs to do. It needs to put the economy into a recession. If it acts quick, if it continues raising by 75 basis points to 100 basis points, each and every FOMC meeting, it can crater inflation. It can do the right thing and cool consumer demand and bring us back to normalcy. But if it doesn't do it quick, it's going to drag it out, and it's going to be worse off than we would have just simply putting ourselves into a short-term recession. They need to pull a Paul Volcker. They need to continue expanding the federal funds rate like they're doing right now. We need to get up to our target rate. We need to get up towards 3, potentially 4, 5% here in a very short period of time, get it over with, and end the cycle. But if the Fed starts to pivot, it starts to change course, like some people are calling for, like so many people were hopefully begging for over the past couple of months, things are going to get much worse, much, much worse. This is not being too doom and gloom. This is being a realist here, guys. We've had more than a decade of easy money and easy investing. And unfortunately, there are too many people out there telling people how to think who haven't thought outside of that 10-year window. Once you exit out of a secular bull market, you are much more likely to face a heavy depressionary bear market that goes much further than a 20-30% decline in stocks or an 80% correction in Bitcoin. How far can we go for Bitcoin and Ethereum's price in a market where equities decline 40, 50, 60% and go through a proper recessionary bear market? Perhaps the price levels we talked about earlier may not be too crazy after all. Anyways, guys, I've rambled on a good amount. If you enjoyed this video, 2 things you guys could do that would really support the channel. Drop a like. If you haven't already, consider subscribing. And also share the video with a family or friend member. I guess that was 3 requests. I don't want to ask too much of you guys, but I hope you all enjoyed today's video. And if you like this kind of content here, you can not only check out some of our partner tools down below, great ways to support the channel and also get more insights on where we stand. But on top of that, you can check out the Dash report down below in the description. It's a great way to get insight into what we think about the market, our trade setups we're watching. There's a lot of opportunities here, even in these scary times, guys. Even though we're mainly focused on preserving capital right now and remaining in cash, there are definitely trade opportunities we take advantage of. And we'll be sharing that within the Dash Report Alerts group. But that being said, everyone, Thank you all so much for watching. Have a wonderful rest of your day, and I'll see you all in the next one. Take care, everyone.